There are a lot of headlines questioning and even predicting a residential real estate market crash. Predictions from Fannie Mae and federal regulators during the 2008 crisis have many investors uneasy about the residential real estate market. So, are we in a bubble as the Fed suggests? Can we expect a crash soon? And how does all of this affect average investors? Well, that's what we're getting into in today's video. Brian, I want to start with some of the recent headlines. The first one is from CNN. You'll see it here on the screen. The housing market looks like a bubble, 2008 regulator says.
Sheila Bair, who had a front row seat to the subprime mortgage meltdown, is worried today's housing market is unsustainably hot. For those who don't know, Bair served as a federal regulator when the housing bubble popped in 2008. The article goes on to say, the median home price of an existing home stood at just $278,200 in August of 2019, according to the National Association of Realtors. That figure has since spiked to $407,100 as of August 2023. Bair told CNN, talk about a bubble, that's a classic supply-demand imbalance. She goes on to say, home prices need to correct downward. She's not confident this will happen anytime soon because there's still a shortage of homes on the market, and she doesn't expect the bubble to violently burst. What she's saying here doesn't make sense.
No.
Because home prices don't fall in an economy where jobs are expanding, wages are rising, and supply outweighs demand. Unless the numbers we are receiving aren't actually real, but that's another story.
That's a great point, and it nicely sets up my next question, which is, can we trust the word of someone who was a federal regulator before and during the 2008 crisis?
Good point. In my opinion, I'd rather look at the facts. And here's where we're at today. The 30-year fixed rate reached an all-time low of 2.65% in January of 2021 and has surged to 7.79% in October 23, according to Freddie Mac. Currently, we stand around 6.5%. During times of low interest rates, housing prices will increase as there's a huge demand for housing, and this is where you'll see multiple bidders above asking price for homes.
Yeah.
That's called a seller's market.
Seller's market, right.
Yeah. Usually when the market corrects, like it did in 2008. But this time's a little bit different. I believe as interest rates start to fall, loan demand will increase and home prices will still rise because we still have a supply issue of homes. And I think inflation is still going to rise this year. You can't have record union contracts signed between all these companies and employees with 30 to 40% pay increases and not expect that money to flood the economy. Isn't that inflation?
Well, last time I checked it is, but perhaps the White House has a different opinion. Sorry, I just can't help myself on this. We live in a clown world. Woo. So yeah, I mean, it is inflation. That's what a textbook definition is. And key factor to watch in the area of real estate, what's going on with the agents? New data shows that 31% of real estate agents in the US could not afford to pay their office rent in December. Now, this is slightly down from 37% in November. While the situation seems to be improving, is it a concerning sign? I mean, a lot of people think it is.
Inventory is declining for sure. In December, we saw pending home sales drop 32% from a year ago, the lowest level since 2015. But if you keep reading in the article, you'll see this. The National Association of Realtors saw its membership rise to an all-time high of 1.6 million in 2021, up from 1.49 million the year before.
Yeah.
But with the available inventory dropping off a cliff and interest rates on the rise, many agents are floundering.
So there's a lot more competition in the market with inventory and lowering sales. So that tells a completely different story than the headline suggests.
Exactly, it does. Plus, how many real estate agents are part-time? That factors in also.
Yeah.
Here's the thing. It's easy to get caught up in these headlines. But if you read these articles in full, you'll see they're selling from fear. Sure. I remember 2008. I lived through it. I was affected by it. This isn't 2008. And I can tell you that today's housing market differs from the 2008 crash due to stricter lending standards and more fixed-rate
mortgages, right.
Housing experts are divided on whether the housing market will crash in 2024. Yes, there's some warning signs, such as high mortgage rates and inflated home prices that suggest challenges ahead, but there's also factors that may prevent a crash. A big factor is that many homeowners today have equity still in their home, reducing the risk of underwater mortgages, unlike 2008.
Exactly.
And yes, there are inventory constraints, and prospective home buyers face affordability challenges and may need to consider alternative options. But this is not 2008. It's something totally different.
It's interesting how we, just human beings, will collapse stories. When something doesn't feel right,
Right.
we collapse the trauma because it was traumatic. It really
It
was.
was.
And it was horrible what happened. But how, sometimes you just have to step back and separate the story, I should say. So you mentioned affordability, Brian, which is another contributing factor to the slowing housing market. When it's actually cheaper to rent than it is to buy, which it is right now, of course the market's going to slow down because there's less demand. You now have to make almost six figures to afford a typical house.
Yeah.
How many people does that leave out of the home buying process right now?
A whole lot.
Yeah.
Between high interest rates and the median price of a home right now, which according to Redfin was 412,000 in September 23, it's kind of concerning.
Wait a second. So the median price of a home is 412,000?
According to Redfin, September 2023.
Wow.
Yeah. The gap
Wow.
the gap between renting and buying is definitely widening.
Sure.
The average mortgage payment is $2,883 on a 30-year fixed mortgage today and $3,759 on a 15-year fixed mortgage. Compare that to the average American rent payment of $1,326 a month.
Yeah.
Two factors that have widened this gap between renting and owning is the rapid rise in interest rates and the shortage of affordable housing.
Well, obviously, high mortgage rates, the actual cost to purchase a home, and inflation affect the average investor, and it lowers demand.
Yes.
Nobody wants to go out there and try it right now.
Right.
So how else does this current environment affect people like you and me? Let's go there.
It really depends on the type of investor you are. Are you a flipper or a long-term real estate investor?
Okay.
The thing to keep in mind is that there are different implications for short-term flippers and
Yeah.
long-term real estate buyers. Short-term flippers, who typically buy properties with the intention of renovating them and selling them quickly for a profit, may face difficulties in finding suitable properties to flip.
Sure.
You got the tight supply of homes for sale, and the lowered home sales market can limit the availability of properties that meet their criteria to actually make a profit.
Profit, right.
Also, high mortgage rates can reduce the pool of potential buyers for the flip properties, which could potentially affect the speed and the profitability of their sales. Flippers may need to be more selective in their property acquisitions and consider the potential for long-term holding periods, or adjust their profit expectations. That's a problem for flippers. They're usually in and out as quick as possible to make the most money.
Sure. And that, if a lot of them decide to sit on the sidelines right now, that also adds to,
Yeah,
you know,
less buyers on the market.
exactly. So what about home buyers who aren't flippers, people who just plan on staying in their house a couple of years? For example, I know a lot of people who have young families and now they're like, okay, it's been 3 years. We've had this house. We have to move to a bigger home.
Sure.
Seems to me that you're going to have to stay in your home longer to maximize your profits right now.
If you don't plan on being in a home for more than just a few years,
Yeah.
you may be better off renting right now than buying.
And waiting and purchasing something later.
Yeah. Now, if you're a long-term real estate buyer, such as an investor looking for rental properties or just trying to buy a primary residence, you might find some advantages in this current market condition. The slowdown in the housing market can lead to decreased competition from other buyers, allowing for more negotiating power and potentially better purchase prices.
Yeah.
You're actually starting to see on Zillow right now, prices are dropping on houses. Oh, this one dropped 27,000. This one dropped 12,000. So, and here's another thing. You're no longer going to lose homes to higher bids over asking price.
Boy, that period we went through right after 2020 was crazy with people just outbidding each other.
Anyway, exactly. So that changes the environment for you if you're a long-term buyer.
Yeah.
Plus, also, long-term buyers who intend to hold properties for an extended period may be less affected by short-term market fluctuations and may have a better chance of benefiting from potential future market recoveries.
Let me ask you this final question. Do you think, I know you don't have a crystal ball, but do you think that the residential real estate market is in danger of a crash soon?
Anything could happen. But I think the key takeaway here is to look at the facts, the data, and not let the sensational headlines send you into a tailspin and change your outlook to doom and gloom.
Right.
If I were to predict a crash, I would say I'd be more apt to say it's in the commercial real estate market, but that's for another time.
It is. And you're right. It's brewing. That's for sure. All right. Well, this has been an interesting conversation. Thank you so much. I think the big takeaway here is just look at the facts and dig beyond the headlines. I mean, we just mentioned a few here, but when we were preparing for this video, the amount of negative headlines, and then you get into the article where there's actual data showing the
Good data
opposite.
inside there.
Yeah. I mean, it's going to have to step back, take the emotion out of it, so to speak. And that's easier said than done. All right,
Yep.
Brian, thanks for this. If you like the content of this video, hit that like button, help us grow this channel, and don't forget to subscribe. Brian and I put out videos on the daily that help you make the best decisions for your financial future. All right, Brian, great conversation. Thanks again. And as always, thanks to everyone who watched.
Thanks, everyone. Have a great day.